at the history of Disney, and I suggest people study the history of Disney, they're a great example of every kind of this risk. Right? The share, I'm going to do this very fast because I don't have time. The shareholders lost a huge amount of money when Frank Wells died in a helicopter skiing accident. The number 2 guy at Disney dies helicopter skiing, and it creates billions of dollars of damage. An unlucky event. The CEO, Michael Eisner, goes to war with their most talented executive, Jeff Katzenberg. Billions of dollars of damage because they couldn't get along because Wells dies in a helicopter skiing accident. Eisner has a heart attack in the hospital. He forms a relationship with Michael Ovitz and brings in a new president who isn't successful and isn't suited. Billions of dollars of damage is done. Ovitz goes on and makes a lot of decisions which create billions of dollars of more damage. Eisner fires Ovitz, billions of dollars of more damage. Disney is threatened by Pixar and computer animation technology. And so they have to do a deal with Pixar. And then Eisner gets in a war with Steve Jobs. Billions of dollars of damage in that war. Eisner is fired. Billions of dollars of damage. Iger is elevated, and he actually goes and does some pretty expensive acquisitions. Acquiring Lucasfilms, acquiring Pixar. But then that sort of works. And then Iger retires, life cycle issue. Bob Chapek takes over. They're faced with the existential threat of streaming video. They start investing huge amounts of money in streaming video, billions of dollars it costs. Chapek, goes through COVID, and during COVID, the cruise lines that I diversified into get shut down. Disney Cruises, disaster. Disney Hotels shut down, a disaster. Disney theme parks shut down, a disaster. Then human resources issues pop up, and Chapek gets in a big fight with Ron DeSantis over Republican cultural, politics. $1 billion disaster. Iger decides he wants the job back. They fired Chapek. $1 billion disaster. Now Bob Iger is back at age 72. Outside shareholder activist sues the board. This is just one example of carnage and anxiety after another for 25 years. And this is like the successful company. And this is kind of the life of the equity shareholder, just living in anxiety. And every other company has the same story, and they will continue. So I guess I would summarize with this. On one, there's the famous Saint Exupéry quote, right? The design is perfect when there's nothing left to take away. If I take a company and a product, I take away the product, I take away the board of directors, I take away the CEO, I take away the facility, I take away the nexus, I take away the brand, I take away the employees, I take away all the trading, I take away all the motion, I take away the competitors, I take away all the new ideas, I take away all of the uncertainty and the volatility, I take away the human factors and the life cycle, I take away the life and the death and the aging, I take away the drama. What have I got left? I got Bitcoin. Bitcoin is a company where I stripped away 24 different risks. You want to ruin Bitcoin? Every time you want to come up with a new idea, let's change the protocol. Let's do this. Let's do that. Let's make it better, right? You get Ethereum, right? Ethereum is, I got all these new ideas. They have 10 years worth of new ideas on the roadmap. They have new ideas all the time. This idea, that idea. If you want to convert your commodity, which is money, into an equity, which is technology, you keep injecting new ideas. And the arrogance of humanity is human beings are born thinking that they're bulletproof and indestructible. And for whatever reason, we're all so arrogant, right? 1.7 million years ago, somebody figured out how to run a stone axe factory. And I bet you, everybody listening to this podcast, if I dropped them in the middle of the wilderness, they couldn't figure out how to manufacture stone axes and set up a factory and turn out 500 a month. They'd probably all die of starvation. Yet 1.7 million years ago, people figured it out. They created an economy. They invented all this stuff. And the human race keeps inventing and forgetting and inventing and forgetting and inventing, and they rise to a certain level. So every new generation, age 18 or 22 or 25, they think that they're going to do it better. And therefore, they want to, I could run that company better. I could build that product better. If I was in charge of the city, I could run it better. If I was in charge of the economy, if I ran the football league, if I invented the new game, if I invented the new product, if I was in charge of marketing, everybody thinks they could do it better. And what they don't realize is they have this inventor bias because they invented it. It's their idea. They think it's beautiful and it's a million times better than any other idea. And they have an ignorance. They don't understand all of the ways that it won't be better when it gets introduced. So a corporation, when you're a corporate shareholder, you think by owning a company, you will have something which will outperform Bitcoin. You're going to outperform perfect money. And the only way to outperform perfect money is you have to outrun, you have to manage all of the risks I mentioned and outrun the currency debasement rate. You have to manage every single risk and grow more than 7% a year, in your working capital. And that's how you outperform perfect money. And maybe all these things worked better in the past because we never had perfect money. Right? Because people thought, I'm trying to outperform T-bills, right? I can't use gold as a medium of exchange. I can't have gold running through my veins. If I had gold running through my corporate veins, then my money has a half-life of 35 years, right? The energy in my working capital lasts 35 years if I have gold running through my veins. But if I have the US dollar running through my veins, my money has a half-life of 5 to 10 years. 10 years, let's say it. So in that particular case, it was a different thing. But now you could have Bitcoin as your currency, store of value, medium exchange, and has a half-life of infinity. So what that says theoretically is you should probably be doing a lot less with your working capital, and you should be saving a lot more. That's another way of getting to this idea that in a fiat world where the currency is collapsing, you have to buy and do anything with your money because the currency is going to zero in a hurry, right? You live in Zimbabwe, you'll buy stacks of soap and toilet paper and anything that's tangible and do anything because you might as well spend it on food, eat, drink, be merry, for tomorrow we die, right? So in an economy like that, all of the economic energy goes toward consumption, dissipation, or even production or experimentation in the near term. But in an economy where you have perfect money or properly engineered money, you really start to say, well, the risk of doing all this other stuff is so high, I shouldn't do it. As an individual, you shouldn't have so much allocated to equity, right? You should be shifting your portfolio away from things that have a theoretical return of 7% or 5%. It ought to have a theoretical return of 20%, and there aren't many things that have a theoretical return of 20%. So you should shift away your capital back to strong money because Bitcoin is this risk-free return over the long term. And that causes the individual to be a saver. If you're an investor, it means that institutional investors should shift their capital allocations away from equity, and you shift toward a stronger money. And if you're a corporate executive, you should shift your instead of doing $1 billion acquisition, you would just keep the $1 billion and keep it in your treasury, right? Like MicroStrategy doesn't have to invest $1 billion in buying another business intelligence company because we have $1 billion on our balance sheet in Bitcoin. right, or billions. So we can simply hold the Bitcoin and get a yield and a return for our shareholders over the long term. So the way that you think is going to change. And ultimately, I think that as people understand the risk factors embedded in equity, then the consumer, the family, the individual investor, the family, the institutional investor, the sovereign wealth fund, and the corporate treasurer, and the institution, the agency, all of them will change their view and their allocation, because it is much less rational to be using equity and equity indexes as a store of value when you have an alternative which is properly engineered. One could argue that, gold wasn't fast enough and it lost favor as money. And so people all migrated, for a while they migrated to sovereign debt as a store of value. And that makes sense. Sovereign debt is a store of value when the interest rates are 7 or 8 or 9%, and the inflation rate, the monetary inflation rate is 7%. It's not a great idea. I mean, it basically is a parity store of value, right? A great store of value yields 14% against a 7% inflation rate. A good store of value yields 7% against a 7% inflation rate. A crappy store of value yields 3% against a 7% inflation rate. When that happens, everyone stampedes to the S&P index or ETFs or equity indexes or just raw equity. And that's what's happened in our economy in the past decade. And I think the world's rational. As people get educated, they will gradually reallocate their portfolios. And I would say right now, clearly, the world is overeducated and over marketed in equities, right? We have much more of the financial education infrastructure allocated to educating people on equity and ETFs and mutual funds. I just went to a conference. I walked through an entire conference, and there's thousands and thousands and thousands of expensive, sophisticated financial professionals in suits that are explaining to you, one of their 8,000 mutual funds or ETFs or something. So the world is overeducated in that, and the world is undereducated in sound money and Bitcoin.